Hey, good morning once again, options traders. And I received a good email from one of our traders asking about the risk of a covered call having gone in the money. And this is a common question that you get from new traders, really against any strategy where you are selling calls. So it could be for things like diagonal spreads, vertical spreads. But whenever you sell a call and it goes in the money, is it really a risk? Because if you see it as a risk, you're going to make bad decisions. So I'm really just using the covered call as an example, but for any of you who are selling calls as part of some type of a spread, covered calls, diagonals, vertical spreads, you want to make sure that you don't see it going in the money as a risk. Otherwise, you're going to make bad decisions. So let's just look at the covered call example and find out why it's not a risk. So recall what the covered call is. It's a strategy where you are going to buy shares, or maybe you've already got them in the account, and then you are going to sell calls. It's always done in a 1-to-1 ratio, which means that for every 100 shares you have, you could sell one call. If you have 400 shares, you could sell 4 calls. Now also remember, just because you might have 400 shares, if you use the covered call strategy, it doesn't mean that you must sell against all 400. You just wouldn't want to sell against more than that, because then you have what's called a naked position. But regardless, it's always in a 1-to-1 ratio. So for instance, let's say that you buy 100 shares at $100 a shot, and you sell one May 105 call, and you collect $2. Now when you do this, you have the potential obligation to sell those shares for the 105 strike, no matter how high that stock price rises. And this is what sets up the misperception that it's a risk if that stock actually gets above 105. So for the strategy that we're looking at here in this example, buying stock at 100 and selling the 105 call for 2, this would be your risk graph at expiration. Notice we get the bend at 105, our strike. So the question that we're trying to figure out is that if the stock goes to this level, up to our 105 strike, or higher, anywhere up in here, is it a risk? Well, the risk graph gives you some pretty good insights. Notice that this flattened portion on your risk graph is the highest part of the entire risk graph. No portion sits higher. So this actually tells you it's the area of maximum gain, and in this example would be $7. And that's because you've made $5 of capital gains. You bought the stock at 100, you have the obligation to sell at 105, but you also collected $2 from the call. So that's where your $7 is coming from. But notice where the real risk is. It's down here. You own the shares of stock. They are sitting in your account. So you are going to take all of the losses to the downside, minus the amount that you collected for the call. But you still are holding the bulk of the downside risk. But let's take a little more of an in-depth look and find out why this is not a risk, just because the stock happens to be getting well above this strike. Well, let's take a look at this table. Here are various stock prices, 106, 107, 108, 109, and then we're going to jump way up to 120. So the call premium in this example was $2. Remember, once you sell an option, that's the most you can make. So that's going to be 2 across the board. That's never going to change. The 105 call, though, will change its value. Sure, you might have sold it for 2, but let's say that the stock goes to 106. So these prices here in red were done in a pricing model, so that the 105 call came out to 2 when we sold it, and these are with 30 days to expiration. But you're going to get the same analysis and the same outcome regardless of the prices. So take a look at what happens if the stock goes to 106. That 105 call is now worth 465. See, you sold it for 2, and this is what makes people think, oh, it's a risk. I sold it for 2, now I've got to pay 465 to close it out. I'm losing. If the stock goes to 107, the 105 call is worth 522. We sold it for 2. Oh, I'd have to buy it back for 522. Now I'm taking a bigger loss. And so it goes all the way up the line. And the reason that people have this misperception is that they're just looking at this part of the puzzle. They're looking at the amount that they received and the amount that they would have to spend to close it. And what they're forgetting is that this strategy has two components. Yes, you have the short call, but you also have long shares of stock. So remember in the example, you bought shares for 100. Well, if the stock goes to 106, now you've got a $6 unrealized capital gain in the stock. With the stock at 107, you've got 7 points. With the stock up here at 120, you've got 20 points. So look what's happening. The stock goes to 106. You receive $2. You've got $6 of an unrealized gain. So add those two numbers in green. That's $8. Now subtract out the $465 that you owe, and you're up $335. Stock goes to 107. Yes, that call is worth $522, but you've got the $2 that you collected from selling the option. Now you've got a $7 unrealized gain. We add the 7 and the 2, that's $9 that you're up, minus the $522. Now you're up $378. And look what's happening. We're going from $335, $378, $416, $452. It's getting higher and higher the deeper in the money that option goes. So with the stock way up here at 120, we keep $2. We have $20 of an unrealized capital gain. That's $22. Yes, the 105 call is worth $15.44, but when we subtract it out, we're up $6.56. So you can see what's happening, that if we push this stock price higher and higher, this number would eventually hit 7. That was the maximum gain that we saw in the profit and loss diagram. And at that point, it is not ever going to get any higher. But you'll still find that the gain in the stock is offsetting the intrinsic value in that option. And so it's not really a risk. This is why we look at it as a regret point or a missed opportunity, but it's not a risk in the sense that you're losing money. And once again, the reason for that misperception is that new traders just focus on this part. Here's what I sold it for. Now I've got to pay $15.44 to close it out. And they're completely forgetting about this portion. That's why your account value is increasing. Now, yes, it is true, had you not sold the call, you would be up $20 here instead of $6.56. But that's another story. That's looking in hindsight and trying to say what we should have done. Well, of course, we can always look in the past and figure out what we should have done. But if it made sense at the time we did the strategy and it helped for us to meet our goals, it's a good decision. It's not a risk. So one thing that you want to understand from this video is that it's so important to understand the strategy that you're using. In the case of a covered call, if you don't want to sell your shares ever, that's an easy problem to solve. Don't enter the covered call. But if you do, you have to realize that it is possible you might get called away or have to buy this call back at a much higher price than where you sold it. But it's absolutely wrong to think that if the call goes in the money, that it's a risk. Remember, it's always the area of maximum profit. You can call it a missed opportunity, but it is definitely not a risk. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.